This week, grains sparked a broad sell-off across commodities, and the timing matters for farmers, buyers, and portfolios that rely on predictable food costs. When corn, wheat, and soybeans swing violently, pressure spreads to feedstock prices, livestock markets, and even consumer inflation. The trigger stack includes weather surprises, policy signals, and speculative bets that amplify moves. For households watching grocery bills, the price path of staples like bread, tortillas, and feed for dairy and poultry becomes a direct indicator of global risk. Understanding why grains melt now helps illuminate how storms, statistics, and strategy collide in markets this season matters. In plain terms, the grains melt refers to a rapid fall in futures prices for corn, wheat, and soybeans across major exchanges. Traders reverse bets as risk appetite shrinks and funding flows out of commodity funds. When macro shocks hit, risk parity models rebalance, forcing money out of riskier assets into cash or treasuries. At the same time, good or bad weather stories can trigger quick price adjustments that persist as new supply and demand data arrive. The result is a cascading move. Futures contracts slide today, prompt cash grains follow tomorrow, and end users face higher volatility with uncertain profit margins. Grains have a long history of price volatility, shaped by global supply chains, policy shifts, and weather. In the 2010s, extreme drought in the U.S. Midwest sent corn and soybeans to multi-year highs, while the 2012 wheat rally showed how weather alone can spark inflation fears. Since then, funds moved from commodities into tech equities, and then back as inflation concerns re-emerged. The current melt echoes episodes in 2008 and 2012, but today, leverage in commodity markets is broader and faster due to algorithmic trading and index products. Understanding the cycle helps explain why a sell-off one week can morph into a disruption for months. Across exchanges, the sell-off hits producers, processors, and traders differently. Cash markets see wheat spot prices retreat while corn for ethanol margins tighten. Grain elevators face financing pressure as forward contracts prove less profitable, pushing some operators to hedge more aggressively. Exchange-traded funds linked to agriculture lose assets, while hedge funds reweight risk across comms. Central banks watchers point to broad dollar strength and rising interest rates as lenders demand higher margins. In parallel, farmers hedge inputs for next season, lifting fertilizer and seed costs temporarily as demand for credit grows. The net effect is a tighter supply chain and higher volatility. Industry players from Archer Daniels Midland to Bunge find their margins squeezed by price swings and timing mismatches. Livestock producers face higher feed costs, which can ripple into pork and dairy prices later in the year. Retail chains carry price risk as cereal brands adjust promotions and private label strategies. Governments and policymakers watch for food inflation, farm subsidies, and currency effects that can amplify volatility abroad. Asset managers adjust exposures, shifting toward longer duration grains or liquid cash equivalents. User industries such as ethanol, feed mills, and pet food manufacturers recalibrate procurement, storage, and logistics plans to weather the cycle. Macro forces frame every grain move. A stronger US dollar makes dollar-priced commodities more expensive for buyers abroad, cooling demand. Global inflation pressures prompt central banks to tighten, lifting real yields and drawing capital away from risk assets. Trade tensions and sanctions can disrupt supply routes for corn and wheat, especially in Black Sea corridors. Weather returns as a political weapon when shortages appear, as we saw in past drought cycles. Meanwhile, fertilizer costs spiked during supply disruptions, nudging acre plantings and yields. All told, grains trade inside a web of currency, policy, climate, and geopolitics that amplifies every daily tick. Institutions have shifted risk budgets toward hedges and cash equivalents as volatility expanded. Banks price higher margins and grow cautious about commodity-backed lending, while pension funds rebalance toward diversified, less correlated assets. Traders track commitment of traders reports for commercial versus speculative positioning and use spreads to flatten risk. Retail investors flock to ETFs and futures mini contracts, seeking exposure with controlled leverage. Yet many face liquidation risk during intraday swings. Some private farmers and cooperatives lock in inputs with forward contracts, while others delay purchases hoping prices retreat. The net effect is a market searching for balance between risk and opportunity. Bear case scenarios warn that a cascade of weak demand and stubborn supply could extend losses. If a drought worsens in key belt regions, or if Black Sea shipments are disrupted again, prices may spike, creating inflationary pressure that prompts more aggressive rate hikes. Liquidity could dry up if traders retreat to cash, leaving hedges underpriced and volatility extended. A sustained carry in inventories might force processors to curtail production, triggering layoffs or plant closures. Retail demand could slip as food costs rise, sparking economic pain that weakens consumer confidence. Investors must weigh popularity against fundamentals and insurance against tail risks. Retail players can start with education, not emotion, building a simple playbook around proportion, time horizon, and risk. Consider basic hedging with broad exposure to agriculture via ETFs, rather than chasing single crops, which reduces idiosyncratic risk. Use dollar-cost averaging if adding futures, and set strict stop-loss to avoid flash crashes. Watch weather forecasts from NOAA and crop reports from USDA as reliable data points, not rumors. Diversify across assets to dampen drawdowns, and limit leverage to preserve capital during volatile weeks. Finally, track costs, fees, and tax implications so a strategy remains sustainable through cycles and beyond. Looking ahead, the grain complex will likely remain sensitive to weather, policy, and macro shifts, but the pace of moves may moderate as liquidity returns and market structure stabilizes. Traders will watch planting intentions, USDA supply forecasts, and export commitments to calibrate risk. If farmers hedge early, downside protection improves while upside potential persists on weather surprises. Investors should favor diversified exposure, disciplined risk budgets, and a clear timetable for exits. Patience and data discipline beat impulsive bets during extreme episodes today. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.